Hey everyone, welcome back to Corporate Decoder, the place where we unearth whether a company is actually shining or just faking it until they make it. Get ready for a deep dive into Array Technologies, their latest financial report. This company is all about solar power and tracking systems for solar panels. Let's see how they're doing and if their future is as bright as the sun they're harnessing. Also, if you love digging into these kinds of reports with us, do us a favor and hit that subscribe button and join our Discord community link down below. We're looking at Array Technologies' latest quarterly report for the period ending June 30, 2025. It's a pretty dense document packed with numbers and details. Let's jump straight into the money. This is their balance sheet. Think of it as a snapshot of what the company owns and what it owes on a specific day. On June 30, 2025, Array had total assets of about $1.54 billion. That means everything they own, from cash to factory equipment to goodwill from past acquisitions. On the other side of the coin, they had total liabilities close to $1.8 billion. This includes things like money owed to suppliers' accounts payable and a significant chunk of debt. Now, they also have this thing called Series A Redeemable Perpetual Preferred Stock. It's a bit complicated, but it's like a special type of stock that they might have to buy back later. This alone is valued at over $436 million. What's interesting here is their total stockholders' equity, which represents what's left for the actual owners of the company, their common shareholders. On June 30, 2025, this number was actually negative at about $71 million. This often happens when a company has taken on a lot of debt or has a lot of preferred stock that's treated differently. It doesn't automatically mean the company is in trouble, but it's definitely something to watch. All right, moving on to how they actually made money or lost money over a period. This is their income statement. For the 3 months ending June 30, 2025, they brought in $362 million in revenue. That's a pretty good jump from $255 million in the same period last year, a solid 42% increase. For the 6 months ending June 30, 2025, their revenue shot up to $664 million, an impressive $624 million, an impressive 62% increase compared to the same period in 2024. This growth is largely thanks to their main business, the Array legacy operations, which saw a massive 69% revenue increase in the first half of the year. But here's where it gets interesting. While revenue is up, their costs went up even faster. Their cost of product and service revenue zoomed up by 85% in the first half of the year. You can see this impact on their gross profit. Consolidated gross profit grew by 23% for the first half of the year, reaching $173 million. That sounds good. But their gross margin actually dropped to 26.1% from a much healthier 44.5% last year. Imagine selling 100 widgets and making $34 last year, but only making $26 this year, even though you sold more widgets. That's basically what happened here. For their main Array legacy operations, the gross margin took a hit, dropping from 42.2% to 29.6%. They attribute this to lower selling prices because raw material costs decreased when contracts were signed, and also higher cost per watt due to things like tariffs and some one-time charges. However, their smaller STI operations segment showed some improvement. Their gross margin actually went up a bit. Their general and administrative expenses also increased by about 19% in the first half of the year. This reflects higher employee costs and expenses related to those acquisitions they've been making. All of this is reflected in their income from operations, which did grow by 53% for the first half of the year to $73.6 million. So despite the margin squeeze, they are still becoming more profitable overall. And look at this, a $14.2 million gain on extinguishment of debt. That means they paid off some debt for less than it was on their books, which is always a good thing. Their income tax expense more than doubled in the first 6 months of the year. They did mention benefiting from tax credits, but also higher profits in non-US locations impacted this. Ultimately, their net income for the first half of the year more than doubled to $60 million. That's a substantial improvement, but with that shrinking gross margin, it shows how much they are relying on growth in sales volume to offset those high costs. Now let's look at where all the cash is coming from and going. This is their cash flow statement. For operating activities, cash provided was $30.8 million in the first half of 2025. That's down from $51.5 million in the same period in 2024. Even though their net income looks good, the cash coming from day-to-day operations wasn't as strong this year. This is often due to how they manage their working capital, like inventory and customer payments. Financing activities show a significant outflow this year, a use of $12.8 million. This was largely due to repaying debt and buying back some of their convertible notes using money from a new bond issuance. They raised a lot of money with those new 2031 convertible notes, but also used a big chunk to pay off older loans and repurchase some existing debt. Despite these cash movements, their cash balance actually increased by $14.6 million, ending at $378.8 million. So they are still bringing in cash, but perhaps not as efficiently as before. Here's something big they're planning. They've agreed to buy Appia Solar for $210 million. This is a strategic move to expand their product offerings in solar racking and mounting systems. They'll pay most of it in cash initially and the rest later possibly in stock. This acquisition could significantly boost their offerings, but also adds integration challenges and potential future costs. They also just issued $345 million in new convertible notes due in 2031. This is a significant amount of debt. They use the money to pay off older loans and buy back some existing convertible debt. This is a common strategy to manage their debt profile and get better terms, but it adds to their overall liabilities. Now let's talk about the risks. This company operates in a global market and is exposed to all sorts of uncertainties. They're really worried about the global economy, geopolitical issues like the wars in Ukraine and the Middle East, inflation and changing trade policies. These are all valid concerns that can really impact a company's bottom line and stock price. Tariffs on steel and aluminum are a big deal for them because they use a lot of these materials. New tariffs coming in from different administrations could increase their costs or disrupt their supply chains. They are actively watching these trade policies. Government incentives for solar power are crucial for their business. If these incentives change or disappear, their customers might buy fewer solar systems, which directly impacts Array's sales. They're also keeping a close eye on new rules about foreign entities of concern and domestic content for these tax credits. If they can't meet these requirements, it could put them at a disadvantage. They're also dealing with some lawsuits. There are class action lawsuits from their IPO and some derivative actions against officers and directors. While they believe these claims are baseless and the court dismissed one significant case, the appeals process is ongoing. These legal battles can be costly and a distraction even if they ultimately win. They report their business in two main segments, Array: Legacy Operations and STI Operations, which is their European business. Array Legacy is their main money maker, while STI is smaller but growing. Overall, Array Technologies is showing strong revenue growth driven by high demand for solar. However, they're facing pressures on their profit margins due to rising costs and lower selling prices. They're making strategic moves like acquisitions and debt management to position themselves for the future. The biggest strengths are their market position and the overall growth in solar energy demand. Their biggest weaknesses are the shrinking profit margins and the significant impact of external factors like tariffs and government policies. They have a lot of debt, which always adds risk. So my take is Array is riding a strong wave in the renewable energy market with good sales growth, but they need to get a better handle on their costs to truly boost profitability. The ongoing legal battles and trade policy uncertainties are also significant risks to watch. It's a company with a lot of potential, but also a lot of moving parts to manage. What do you think about Array Technologies' financial health and their strategies going forward? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the corporate world. Don't forget to join our Discord community for more direct access and discussions. Thanks for watching, and we'll see you in the next one.